Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending July 24th, 2020. I'm Preston Brent. Thanks for tuning in. Remember folks, don't be a rat brain trader, be the red striped zebra. And the theme this week is the dark side of the moon. So let's just kind of jump in and see what we had this past week. Just kind of see where all the indexes went to. If we take a look at the performance of the US markets, you can see pretty much everything has been in the red. The Dow, S&P, Nasdaq, Russell, all in the red. The Nasdaq's the only one that's year to date in the green, but Nasdaq, we've had a rare couple of weeks in a row where it's finished lower. Um, but Nasdaq is still, even with a couple of weeks being down, is still comfortably up 15.50%. Of course, if we look at the sector performance for this past week, energy came in tops 2.21%. Worse, again, technology 2 weeks in a row leading the markets lower this past week, down 1.86%. Of course, if we look at the world index and the performance across Europe, you can see the FTSE, CAC 40, the DAX, that would be the London exchange, the Paris, and then the German exchange, all in the red for the week. The only market in the green for the week was the Nikkei over in Japan, up 24 basis points. China and Hang Seng, the Hong Kong index, were all down as well. Now, if we kind of just take a look at valuations, they're still a bit stretched. The 12-month trailing PE ratio is 30.59. Now, the forward PE estimates for forward earnings are 25.47 for the PE. It's lower than the trailing by 16.73%, but still well elevated when the longer term average is around the 15, 16 area. Dividend yield for the S&P is this past Friday came in at 1.9% so far. 10-year Treasury fell again. It closed out the week at 58.9 basis points, so a little over or a little under 0.6% for the week. And the spread between the 10-year Treasury and the dividend yield is 1.31%. So that still is forcing money into the U.S. market, into the equity markets. Okay, so we're getting a number of things kind of coming in for us here. If we take a look at the weekly sound bites for this past week, technology shares, as I said, they're down about 2 weeks in a row. Nasdaq down. We had a lot of the gains that we had earlier in the week just turning abruptly south on Thursday. The S&P was near its all-time high, and then it pulled back. Again, as I said, technology, the tech-heavy Nasdaq had the worst week for the week. It kind of dragged everybody else down. Okay. And we're seeing some of the worries surface in the U.S. markets from the number of rising cases in the COVID stimulus, or the COVID COVID stimulus, the COVID number of cases, and then the closure of the Chinese Consulate coming in towards the end of the week. So that tended to push markets down. Now, earnings. We're going to get last week. You're seeing some of the earning from some of these companies, especially from tech, pulling back just a little bit. The big five: Facebook, Amazon, Apple, Google, Microsoft. That accounts for about 22% of the market cap of the S&P. It kind of shows the narrow breadth that we've got in the current markets right now. But to get a more solid idea of how tech is going to fare this week is going to be huge. We get Facebook, Apple, Amazon, Google, all of them coming out with earnings this week. Now, last week we saw Microsoft. They actually beat on top and bottom line, but some of their internal numbers were not as strong, especially in cloud services. So it pulled back a little bit, and that helped send the NASDAQ down. So no doubt, has weighed on the S&P and the Dow this past week, with Nasdaq pulling back. So this week is going to be big. I mean, it's going to be really big for the earnings perspective. So we're going to have to watch it very closely when these big guys start to come out, and finalize some of the FANG earnings reports. Now, the economic activity this past week, it was mixed. We had some cautionary signals that growth was kind of slowing after this huge rebound off the late spring, around March 23rd lows. We saw this past Thursday the unemployment claims from the previous week, they actually rose from 1.31 up to 1.41. So that's not a good sign. This is the first time that we've had an increase since March, actually, in the unemployment claims. So that's not, it could be just a momentary blip, but we got to watch it. I suspect some of it is due to the rise in cases and the re-shutdown of a number of businesses around the U.S. Country. Okay. Also moving lower this past week was the U.S. Treasuries, 10 years, moving down as Feds are targeting purchases out in time, the 20 and 30-year bonds. That's continuing to have the effect of driving the 10-year down very low. Okay. So now the other thing that it's doing is we're seeing the U.S. dollar coming under continued selling pressure. Okay. We're hitting 2020 lows for the U.S. dollar. Remember, it's a dollar index, so it's measured against other basket of currencies, but primarily the euro, yen, and British pound. As those guys get a little bit stronger, the dollar's being pushed down. In fact, we haven't seen lows like this in the dollar since 2018. Now, you throw on top of that, of course, this massive stimulus, and what the Feds are doing in purchasing 20 and 30-year Treasury bonds. It's pushing the rates down. As I said, the rates this past week, they finished at 58.9 basis points, just under 0.6%. But the other thing that it's doing is that we're seeing with a lower dollar, strength across all commodity sectors. I mean, just look at precious metals like gold and silver. They're up very strong. Copper at 2-year highs. Materials sector will tend to benefit also from a weakened U.S. dollar. And should the dollar go lower, it's going to help large international corporations because the dollar is cheaper, and about 60 to almost 70% of all international transactions are done in US dollars. So it's going to help emerging markets and things like that. So we're getting some of that as well. So it's going to change some of the dynamics of the market. And then finally, after about 5 days of haggling, the EU leaders this past week came up with a historic deal on with about 750 billion euro stimulus. It's a little bit with the exchange rate now about $1 trillion in dollars. So as a result, the European Commission can now raise billions of euros in the capital markets on behalf of all the member countries, right? So the fund is going to be about 390 billion in grants, so they don't have to pay that back. So they cut the grants down, but it's still going to be a lot of low interest rate loans as well. And Italy is kind of forecast to be the biggest recipient of what we're seeing right now. So these are just some of the short sound bites of what we had this past week, and then what we got coming up this week. So what I'm going to do is I'm going to shift the screen here, and let's just go take a look at the E-mini S&P 500 futures. And I want to take a look at a chart that's got the fib node extensions off the March 23rd lows. So I'll wait for this to paint the screen for you guys. And as we look at this, you can see here that we actually moved into the green for the year, but just for a few days. We had 3-day closing bars. So we were 3 days in the green, and now we moved back down again. But it shouldn't surprise everybody. I had our members picking up puts a week ago because we had what looked like a potential bearish divergence setup, and we got it. Our group, we call this a bed, right? As opposed to what we also call a poor man bed, where you got multiple crosses in the MACD line and the trigger line. We just had 3 crosses, one here, and one here. Beautiful bed. And that suggests that the pullback is going to be a little bit more than just 1 or 2 bars. Now, naturally, you can see this volume over price going back to mid-April. We got a lot of potential buyers sitting right below that fib node, that fib extension node of 0.786. So it's looking at around 31.35, okay? And then right below that, we've got the 50 SMA. Now, these are SMAs, not EMA. So right at 30.97 and then down to 30.36, roughly, down in this area here, okay? So we've got some support points that we can watch, but should we blow through this, there's very little volume over here to stop it until it comes down to the 618. We got a little bit of a volume spike here, and then all the way down here to around the 2840 area, taking us down to the 50% node, which is right at the 50% point from the low to the high that we've had this year, and that's a common pullback point and still a bull market. So where do I think we're going to go? Well, the odds, as I've been telling our members, did not fail. I had projected a run up here to around 33.20, as you can see by that colored bar. We didn't quite get up there. We got up to about 32.84, 32.85 area, and then we just started to pull back. The minute we got that cross, right in that area there as we were running flat, I had suggested pick up some puts. In fact, I was talking about over here picking up some puts because it was relatively cheap. And I didn't see a big upside move. In fact, I thought the bigger move would be to the downside, putting us right back at that fib node right there of 31.35. Okay. So as we round out July going into August, the odds still favor a move lower. All right. The bigger move is still favored to the downside at this point in time, but that does not mean we haven't been playing this up move. Okay. So this move here is something that we wanted to participate in. And the markets have been very, very choppy. If we look at these markets here, you can see for this period here, it was a little over 7 trading days, week and a half. We went from green to red, green, red, green, red, green. I mean, we just shifting each day up, down, up, down, up, down. Very choppy as we were trying to get some energy to clear this hurdle. I said if we clear this, we're gonna attack the 32.36, possibly move higher, and that's exactly what we did. And then we had this bearish engulfing pattern right there, which was confirmed by a bearish divergence cross right there. And that was, for those that were late in picking up puts, that was another. You had a couple of chances to pick up some puts here or just hedge your portfolio, depending on how many long deltas you were carrying. This was something that you just wanted to make sure you were hedging against right here. Now we've got a cross down here, the 5200 cross. You've probably heard me say before, it's also a very common area to reach a pullback point too, because by time the 50 crosses the 200, you're well in advance of the cross just because of the nature of the lag in the 50 and the 200 SMA or even the EMA. So generally by time you get the cross, you come back and you test that cross at some point. That would put us just slightly north of 3,000. Now this week we got a number of things, as I said, coming up that could really move these markets. We got Facebook, Amazon, Apple, Google earnings, all 4 of these big ones. And remember, they're a large part of the weighting of the S&P. We got those coming up. We got the first pass of Q2 GDP number coming out towards the end of this week or this coming week. We got the Fed FOMC policy statement coming out on Wednesday. Not a lot of surprises in what we expect from them, but they may give us a little bit of their direction and sense on what they want to do. Interest rates probably are going to stay the same. I think everybody wants to know what they're going to be doing with how they're going to react to the fiscal stimulus and what is their game plan with the dollar getting lower. So we're going to hear that. The other thing that we're going to get is the finalization probably of the fiscal stimulus package for the US. So the Republicans will put their package on the table, marry it with the Democrats. We'll have a battle and then we'll see what's going on. The Republicans are coming in with around $1 trillion. The Democrats are asking for $3 trillion. So they're probably going to meet somewhere in the middle, maybe slightly less. But either way, it's going to have a tendency to goose the markets higher, regardless of what the chart action looks like. But again, it's going to be a near-term phenomena, and then eventually, as I said, probably in the month of August, short of any other news on vaccine success stories or things like that for COVID, or success story of number of cases pulling back again, the price action just basically wants to go a little bit lower. That's kind of what we're seeing right now. And these are the touch points that I see with markets. So the first one is probably going to be around the 31.35, then the natural 3,100 level, and then we're going to come down and we're going to test these moving averages should these others break. Okay, so that's a little bit about what I'm seeing on the market there. So let me just flip around just a little bit on the screen. Let me just get these drawings off the screen here. I'm going to repaint the screen, come up here, and I want to show you Nasdaq. Let's get the Nasdaq up here. We'll take a look here. You can see on Nasdaq, these are daily bars. So you can see we've had 4 days in a row and Nasdaq came down. And obviously, once it started rolling over, there's no divergence in Nasdaq, so any pullback is probably going to be met by buyers. You can see the 50 SMA is sitting on 236 retracement. Now, keep in mind on the S&P, I used extensions off the March 23rd lows. On Nasdaq, because it's been so strong, I've used the retracement. And you can see we're at 23.6. You can see all this volume over price sitting right on that line. There's a lot of volume right here, and this is we're duking it out between the buyers and sellers here. Should this break, as you can see on the chart, there's not a lot of buyers sitting down here. I mean, if this breaks that level right there, there's not a lot of volume here. It means it'll probably come down to this level right here for another fight. And that was, if you guys recall, kind of what I was saying around the 10K level for NASDAQ. Okay. And that also happens to put us at the 50 SMA as well. And you can see this wide spread between the 50 and the 200 SMA. And we were up here, we were several 2 to 3 standard deviations above, and that was too far of a stretch for Nasdaq, even with this run up here. So these pullbacks, and you can see the volume here and the volume here, and then it gets a little bit lighter down here. So I'm expecting for this to hold up right here should we come down to that level, which is a 23.6 retracement from these highs here on Nasdaq of 11,058. Keep in mind, I have still a forecast up here of around 11.6, right? 11.6 thousand is what I'm looking at here. So I'm looking on this Elliott wave count of still an Elliott wave 4 somewhere down here, and then away we go. Okay, so that's kind of what I'm seeing here on this chart. Now, what I wanted to show you, let's zoom in on the FANGs here. I created a FANG index that I think kind of shows it really nicely. So let me just switch charts again. I got to take you to another screen here, so just bear with me as I get this screen up. Okay, so I'm going to wait for it to paint on the screen for you. But this is an index of Microsoft, Facebook, Apple, Netflix, Google, and Amazon. Okay. Now, as we look at this, you can also see I got fib nodes on here, fib retracements, just like NASDAQ. You can see we came down and we touched, this is a daily chart, we came down, actually went below, but again, it's where you close for the day, and we closed right around that 23.6. In a very strong bull market, that's a tough one to fall below. That's a typical pullback point in a very strong bullish market. A more common pullback zone in retracements on fib is 38.2 and a 50% retracement. But in a very strong bull market, generally you'll get a pullback to this level here, or maybe down to the 38.2. All right. But this is an index of the FANG plus Microsoft, and this is where we're sitting. So you can see this pullback here again. Like with NASDAQ, there is no divergence here on this. That suggests that this would be an Elliott wave 4, just a natural profit taking, and then away we go, right? Giving us an Elliott wave 5 somewhere up north of here on this FANG index. So this is all kind of lining up here for a little bit of weakness early in the week. Then we're going to get Wednesday and Thursday, we're going to get all those earnings on the tech. You know, as I said, Facebook, Amazon, Apple, and Google, we're going to get those earnings, and we're going to get the FOMC on Wednesday. We're going to get the fiscal stimulus, what that package is going to look like, and then we get first pass of Q2 GDP. Everybody's expecting that number to be south of 25%, 27%. Everybody wants to just kind of read the internals there. So most of that is about as low a bar as you can get. I mean, it's just very low. So that's the good news. But with the number of new cases of COVID coming up and businesses shutting down, I told our members, and you guys too, I mentioned it in about 2 or 3 weeks ago, keep a note on what they do with the coming opening of schools this fall. If a number of schools go back to reopening, more so than anticipated, that'll be good for business, because then parents don't have to stay at home and figure it all out. So these are just some of the things that we want to watch very closely. If we look at volatility, if we look at the front month skew, we're okay. We're in the green, barely. Anything in the green here shows that we're in a normalized contango volatility skew. So the vol skew is still in a normalized mode. And then if we look at the back month vol skew, which is comparing the August and September um, skew, we're still solidly in the green. So markets are still kind of shaking it off, these little bit of a pullback here with Nasdaq. Now, if Nasdaq can pull back and we can get some sector rotation with a weaker dollar in the materials and industrials, and we can see commodities and emerging markets and some other sector rotation, maybe in more value versus growth um, near term, then that'll help keep the market supported. But if the FANG stocks give it all up this week, and the other stocks stay relatively neutral to weak, we're going to see another down week this week. Okay, if we look at treasuries, we look at the 30, the bonds. You can see we're in this tight range. I've been saying, I don't know, going all the way back to probably May, doing iron condors and bond futures are playing flies in this, or in TLT makes a lot of sense to me. And if we look at the interest rate, which is having a tendency to drive markets also lower, this is the 10-year. We've just been slowly moving down. We're going to get to a point where if the 10-year breaks the 0.56, it's also going to be bearish for the markets, because remember, the 10-year is a little bit of the vote in the debt market of what they see over the next couple of years. And the lower the 10-year goes, the more the debt market is basically, their interpretation is, hey, the markets don't look good going a year or two out in time. Doesn't look very good at all. But you may say as a counter argument, well, hell, we're hitting near all-time highs in Nasdaq. I mean, Nasdaq's up, what, 15% for the year. But again, you've got low interest rates, the dollar going down. You've got all this stimulus, trillions of dollars of stimulus. So it's going to have an effect of driving PE ratios higher and creating asset bubbles. All right. We're not there yet, but that's the direction we're going in. Okay. And let's look at the US dollar. I mentioned that earlier in our weekly sound bites. Look at the dollar. We're at 2020 low. We hit a 2020 low this past Friday. We're in the red. You can see the 2019 closing price. Now, I believe we're going to get a bounce in the dollar, but what I'm going to have our members do is any bounce in the dollar, we're going to want to sell it. So we're going to sell a rally in the dollar. And the way to do that is to do the contra, buy the dip in the euro. So if we look at the euro, you can see the euro is also up, making 2020 highs. We're in a huge resistance zone up here with the euro. We made 1.16. I mean, it was just in May, really, where we were down around 107 to the dollar. Now it's 116 to the dollar. It's gone up, you know, 8, 9 points. Or 9 cents. That's huge in currency language. And look at the MACD here. If we get a little bit of a pullback here, it'll set up for a little bit of a bearish divergence. But we're going to be looking at buying a dip in the currency market. That'd be a nice way to play it, I believe. Now let's go look at gold. Gold has been on fire. Okay, you can see here we hit 2020 highs this past Friday. It actually cleared 1900. Okay, I do believe gold is going to pull back just a little bit before it makes another run, but I think I can see gold going up to 2000, maybe 2050 area before having a little bit more of a pullback and a consolidation mode. And let's look at silver. Silver is even stronger. Now, with our members on our Sunday night weekly market watch, I've been suggesting silver over gold. If you're going to get into a precious metal, silver is going to be the outperformer. And it has been. And for a number of reasons, which I'm not going to go into in this weekly roundup. For our members, we go in a little bit of detail on ways to play this and really do very well. We've got a couple of members that have played long silver futures, and I was recommending some of this stuff back in early April. And then speaking of other things that we did in early April, let's look at copper. Copper is just on fire. Here's another one. Look at copper. It's just, you could almost just see the regression channel going straight up, or the actual channel. We're running into a little bit of just a sideways chop here, but there is no divergence here. That suggests any pullback is probably going to be bought. Now, we've played copper. We got long copper late March, early April. Again, it was a great trade. A number of members have benefited from this. So there's going to be some changing dynamics with a weaker dollar, lower interest rates, stronger gold, more fiscal stimulus, and we should get another package this week that's going to be just as strong, if not stronger. Um, so the dynamics are going to change some of the market, and we'll get a good clue on technology this coming week too, as I said, with Facebook, Amazon, Apple, and Google putting earnings out. Let's look at oil. I mean, we're still playing, oil still doing good. This is another one where it's just been in this very tight range here. All right, we've had a way to play oil. You do not want to play USO. And brokerage firms from IB to Thinkorswim have changed some of the ways that they'll let you play the oil market ever since we went below the zero rate back in April. That was a mess for the May futures contract. But I still think oil slowly is going to go back up. The shale patch, they've cut back their number of rigs that that are active now by over 70%. Huge. Now that's going to be like a rubber band. It's going to snap when if the markets come back stronger than expected, when things start opening, it's going to take them a while to pair that back up. And they need oil over $55, $60 a barrel before they can really start coming back full tilt boogie. So that's going to create about a 6-month period where oil is going to get very strong again. So I think the bigger movement in oil over the next year is going to be sideways to up rather than sideways to down. And there are a number of really interesting ways to play that in the market. Members, I'll cover that with you guys this Sunday evening again. And then we'll take a look at a couple of stocks that I see that could be pretty good plays as well. All right, everybody, that's kind of where we're sitting right now in the markets. We're pulling back just a little bit. We're getting the bearish divergence, as you can see here on the MACD, on the E-minis, S&P 500 futures, right? We got that nice little divergence set up there. We're back in the red again. We're right below or right above the moving averages, the 50 and the 200. So I believe we're going to, see where the determination of the fiscal stimulus package, the FOMC, these tech earnings, and GDP Q2, big week. So it's going to help determine price direction for the next several weeks, at least near term for that matter. All right, everybody, have a really great weekend. Members, I will see you this Sunday evening for our weekly market watch. Take care, folks. Enjoy the day. Ciao.